Welcome to the Collecting Keys Podcast, the show where you'll learn how to use real estate to create massive income, not just passive income. Real estate doesn't have to be a get-rich-slow game. Listen to the country's top real estate operators, and you'll have all the tools you need to replace your W-2 income and go beyond in under 12 months. Ready to take things to the next level? Let's jump in with our hosts, Mike DeHaan and Dan Austin, for today's episode of the Collecting Keys Podcast.
All right, guys, we are here today with Thomas Castelli, who is out of New York, and he is with Hall CPA and Dual City Investments. And we are going to be doing a deep dive into taxes today and tax strategies with running a real estate investing business. And so, a lot of people get into real estate for tax benefits, all these different things that people say out there. But what exactly does that mean? And so we're going to do a little investigation on this today. So Thomas, appreciate you coming on the show, man.
Thanks for having me. It's an honor to be here today.
Yeah, absolutely. So I guess when it comes to this whole tax situation, I don't have a ton of knowledge. Dan tends to run with a lot of this stuff on our side of the business. And I either get the
dumb.
You're pretty dumb, yeah. So this is why I work with guys like Thomas. It's not your fault, man. You got blown up too many times. You have brain injuries. But when it comes to tax things, I usually kind of get to the end of, I guess, like the tax season, March, April timeframe, and I'm either super, super disappointed or I am super thrilled that I don't owe any money. But Thomas, you have some strategies and different things around how to sort of prevent that. So I guess at a high view, what do you do as like a tax strategist? How do you help real estate investors?
Yeah. So my job as a tax strategist is to look at your situation and say, okay, well, where are you today? What's your income streams? What assets do you own? What is your current financial and tax picture look like today? And hey, where are you looking to go in the next, say, 1 to 3 years? And the more farther out we can go, the easier it gets to plan for people. But I'm looking at where you are today, where are you looking to go, and what moves, what strategies, what tactics, what deductions, what credits, and so on and so forth can we implement today so that when it comes time to file your next tax return, you're minimizing your taxes to the furthest extent possible, or reasonably possible. I don't want to say to the furthest extent possible, because not all strategies are always worth executing. But basically, it's how can you minimize taxes for your next return, and then also over the big picture, what can you do to shift your business, shift your investments to a more tax advantage overall strategy, so that you're not only doing like the tactical, like day-to-day, like little things, but also from a bigger picture, how can you shift your income sources to more tax efficient income sources?
Yeah. So wait, so you're saying that there's tax things that are not worth doing. So I shouldn't every single year just go and do max depreciation and go and get a cost segregation study on everything and takes max accelerated depreciation and, go and start my money laundering business to hide how much money I'm making. I should probably just be a little bit more strategic than that.
Well, yeah, yes. Most of the time it does make sense to do cost segregation studies specifically, but like a strategy that is sexy, for example, but the juice isn't always worth the squeeze, or it's just not worth the hassle, is something like the Augusta rule, right? Like people hear about this Augusta rule, which allows you to rent your home out for 14 days or less and not pay taxes on it. Well, that's all well and good if you're actually going to go ahead and rent your house out for 14 days and you have like a reason to do it. But what ends up happening is so many people spend so much time on these little strategies because they sound cool. That's just like the amount of time you spent trying to execute this small strategy that's not going to give you that much benefit, tax savings wise. You could have been out there making money, doing more deals, and financing, getting investors, so on and so forth. So that's what I mean. Like when I say to the furthest extent possible, I mean like the big rocks, the things that are really going to move the needle for you, not the little deductions that sound cool but are not really so cool. So that clarifies kind of what I meant.
It seems like there's a lot of stuff, a lot of Instagram accountants out there talking about, especially for the real estate folks. And it seems like to me that those only apply given specific circumstances and goals you have. Like there's certain things that you may not need or want to do from a tax strategy standpoint that somebody on Instagram is telling you is the best benefit of real estate, even though it's not going to fit you because your goal is to maybe sell your property next year, or maybe to never sell your property, or the opposite of whatever would be correct.
Exactly. Yeah. You know what it is about here's the way. So we receive a lot of this at our firm because we consult with a lot of clients, and sometimes they'll come to us after seeing something on TikTok and being like, oh my God, I saw this really cool thing.
This hot chick told me to do this.
Right. Does this work for me? It's like, no, it doesn't always work. So kind of the way that I view the TikTok and the Instagram reels is, first of all, look at what are they trying to do with those reels? They're trying to grab your attention. They're trying to hold your attention so that they can get more views. So they have to do things that are polarizing, things that are sometimes controversial or a little edgy, if you will. Mm-hmm. That's what they're trying to do with their reels. So it's in most reels are not giving you the whole picture in 60 seconds. You can't possibly. So the way I like to tell people, or the way I like to suggest people look at these reels and look at these, YouTube shorts and whatnot, is use them to like spark ideas. You could go have better conversations with your own advisors, right? Like if you hear about this strategy, like, okay, cool, I heard about this strategy. I'm going to go talk to my CPA. Does this apply to me? Because what we often find is the information on those TikTok reels is often incomplete and sometimes steers people in the wrong direction.
People on the internet don't lie or leave out small details that are actually important. But the whole reason we have the internet is so that we can know everything instantly at a couple clicks of our fingers on our phone.
Yeah, bro, my VA does my editing. He doesn't know American tax strategy.
Yeah, but I mean that's an interesting thought though, right? Around, I mean, honestly, the opportunity cost of looking at these different tax benefits, right? This is actually a big thing that we deal with people in our scale community is they come in and they want to like find these really minute details about a way that they can stretch their marketing dollars a little bit farther. Or they go, I'm going to go and start my own property management business so I don't have to pay a property manager 8%. Or they go and they say, I'm going to start doing Airbnbs, going to be able to cash flow a little bit more than a long-term rental. But if you look at the actual time to do all of those things versus if you went and just did more transactions, you're going to make so much less money, and you're probably going to like work more if you're being completely honest and refining that actual skill. And it sounds like the same thing sort of applies from a tax perspective. So when people are kind of looking at that, right, you said like take those ideas and go to your CPA. How do you know that your CPA knows what the hell they're talking about?
Right. Yeah. So that's a great question. I mean, the first thing is like so it's like hiring somebody, hiring anybody, right? You want to hire somebody who has the experience doing what you're doing. So for example, if I'm going to go hire a CPA for real estate, I'm going to go and interview. First, I'm going to search for CPAs that have real estate experience. That's going to be like my first filter, right? Mm-hmm. Then I'm going to get on the phone. I'm going to review their website, their materials, see, are they putting out content on strategies for real estate investors? In 2024, that's a good sign that they at least are going to be in the industry that you're looking for, right? Mm-hmm. And that they're showing some proof of what they can do, right? And the second thing I'm going to do is after I decide to whittle it down to the people I'm going to actually talk to, going to get on the phone and I'm going to ask some questions. Okay, first of all, I'm going to ask, how many clients do you work with that are in a similar situation to me, right? If you're the only client they have in real estate, they might not know real estate, right? But if they have 100 clients that are in real estate and are doing something similar to you, then chances are they probably have an idea. Maybe not, but more likely than not, they do. All right. And then it's like, how can you help me specifically? What things can you do for me? What am I missing? So like, you just want to, it's almost just like hiring somebody. You gotta start your search by looking for somebody who has experience, then, see what their website says, then get on the phone and start having a conversation and drill down. Like I just said, how can you help me? Can you help someone in my situation?
Sure.
Testimonials, case studies help too.
Do you think it's important that a CPA invest in real estate themselves to understand a lot of the nuances, or is that kind of
No, I don't believe it is. I think it helps. To be upfront, but there's certainly a lot of really gifted tax professionals out there that have never invested in real estate in their life, but can tell you exactly what you need to do from a tax perspective, because that's what they specialize in, right? They have a lot of experience looking at a real estate investor situation and saying, hey, I've worked with 100 clients just like you, and I reviewed the tax code ad nauseum, so I know exactly how to navigate your situation. So while it helps make the connections for sure, it's definitely not necessary.
Sure.
So what are some of the, we hear all sorts of things from the benefits of real estate from the tax advantage standpoint. Are there any things that you're doing to advise your clients? And I get it that it's going to be it's going to pertain to client specific situations, but are there any things that you are doing right now that you think are maybe unique or beneficial or that people aren't talking about?
Yeah, I mean, most of the stuff that we're doing at this point has been pretty fleshed out because we've kind of put it out there a lot. But so it's hard to say anything that's like undercover.
Sure.
But really, the big rocks for like say full time investors, there's some key strategies that you're going to want to be aware of and kind of make sure that you're at least exploring, if not implementing. The first one's going to be the real estate professional status. It's also sometimes called reps. And to give a quick overview of what that does, right? So the way way back in 1986, they had the Tax Reform Act of 1986 under Ronald Reagan that was passed. What that did is it made all rental activities passive by default. So that means, and the reason for this is that you used to have like a physician or a lawyer, a highly compensated individual, go out, buy a rental property, do little to no work, but then take a loss thanks to the non-cash expense called depreciation. So in other words, what happened is they're showing a loss for tax purposes, and they're telling the IRS, hey, I lost money, but they're actually making money and putting cash in their pocket. And they would be able to take this loss and then offset against their income from their job or their business and reduce their tax bills. It became really controversial. So Congress made that no longer possible and said, you know what, with your losses from your rental activities, you can only use it to offset other quote unquote passive income, which is income from rentals, unless you qualify as a real estate professional. And what the real estate professional status says is if you work more than 750 hours and more than half your total working time in a real property trade or business, so basically in real estate, then you're able to take the losses from your rentals and use them against your, quote unquote, active income, which is like say income from a job or a business or dividends and interest from notes. Those are actually in that bucket too. In a weird, I don't know why they put it in there, but that's what Congress did. So
I'm actually surprised that Congress did that because I feel like they would just be abusing the fuck out of that now. Like honestly, like they would just be using that to reduce all of their income, just like they do with other insider trading.
Oh, like the real estate professional status?
Yeah, well, like if they didn't have real estate professional status, right? Like they would want to take that away so they can just go and buy a whatever, and reduce their income to zero. If you get what I'm saying?
Yeah.
One question about that then. So for many people, they're not a real estate professional, but they aspire to that, right? But they might be taking very real losses that are above like their passive income. So say you make $5,000 in revenue from your rental properties, but with depreciation and maintenance and all your Schedule E stuff, you've got $20,000 in losses accumulated. So you basically net $15,000. You can't, as a non-real estate professional, you cannot take that $15,000 in loss and apply it to your active income. But if you do that, say for 5 years, and you're finally ready, you've got $100,000 in losses that you weren't able to use, but now you've quit your job and you're a real estate professional, do those losses accumulate so that you can now use them in that first year as real estate professional?
Yeah, so they do accumulate. Okay. So if you can't use them in that first year, they'll be carried forward. You could check on Form 85, 82 of your tax return, just in case you want to take a look of your Form 1040. But what happens is if in the year you become a real estate professional, so the real estate professional only allows you to take losses as non-passive or active in years when you have the real estate professional status. So for example, say you had a $20,000 loss in 2024 and you qualified as a real estate professional, you would be allowed to take that loss. Okay. Now say you're not a real estate professional in 2024, this $20,000 loss gets carried forward to 2025. And in 2025, you do become a real estate professional. That $20,000 loss from 2024 will still be passive for you. Oh,
dang it. I was hoping for all those people out there that were working towards it that they could use that.
Yeah. So unfortunately, what ends up happening is it doesn't all get unlocked. The previous losses remain passive. Yeah. The way around this is to what we advise, what most people will do is say you acquire a property this year in 2024. And you're going to qualify as a real estate professional in 2025 or 2026, whatever it is. What you'll do is you won't do a cost segregation study today. You will hold off. You will just use straight line 27.5-year depreciation, assuming it's residential. And then you will qualify as a real estate professional, say 2025. And then you will do the cost segregation study and you'll have that depreciation retroactively kind of caught up on your 2025 return. And that's how you can kind of navigate that situation to avoid kind of like getting all those losses trapped.
Yep.
And that's kind of just why I mentioned before, like, should you not do cost segregation studies every year? Well, in the most part you do, but in some cases it would be strategic for you not to do it right away, hold off. And this is pretty much one of those instances.
Well, that brings up another question that Mike and I probably both are thinking is like, outside of this scenario, when would you advise people not do a cost segregation? Like, for example, maybe you're going to sell the property or you don't. Like, when is a good example of that?
Yeah. So when you're flipping a property, a true flip, you're typically not going to be, it's not treating it like a rental property. It's usually going to go on Schedule C and you're not going to depreciate that property. So that's one instance where you wouldn't depreciate it. Another one is if you're going to sell usually relatively quickly within 1 to 3 years, because you're going to have to recapture it. It's not always it's not always like a hard no, but it's something that you may not want to do. Another instance, and this is maybe the only other instance that comes immediately to mind around that, would be, so when you use straight line depreciation, so okay, when you depreciate a property, you're reducing your basis in the property for tax purposes, and it's called your adjusted basis. And when you sell your property, you're not selling the property from the market price, whatever you sell it for, the sales price, minus your cost, your purchase price. You're selling it for tax purposes. Your gain is going to be measured on your sales price minus the adjusted basis. So the more you depreciate your property, the bigger that gets. And depreciation recapture, that's what, like, the gain from the depreciation you took, called depreciation recapture. On straight line depreciation, or just 27.5-year depreciation, that is taxed at a max rate of 25%. But when you use bonus depreciation and you accelerate and you spike that depreciation expense, that portion is taxed at ordinary income rates of up to 37%. So for example, say you're in the 32% tax bracket or the 24% tax bracket today. You go ahead, you use a cost segregation study, bonus depreciation, all that good stuff, real estate professional status perhaps. You take the losses and the deduction is going to be at the 24, the 32% rate. But now say you sell the property, 5 years down the line, your income is huge that year. You're in the 37% tax bracket at that year. Now you're recapturing that at a higher rate, 37%. Gotcha. Now there's ways to mitigate that with 1031s and stuff like that, exit strategies. But in just a pure vanilla, traditional, ordinary sale, that's an instance where you not
Gotcha. So in that scenario, what you're basically saying, if I can understand this, normal depreciation recapture, if you're just doing 27.5 years, is 25% of that you pay when you sell it. If you use accelerated depreciation, the part of the depreciation that you're accelerating is at your ordinary income.
Exactly. Okay. Exactly.
What is the difference usually? Like when you do, if Mike and I were to do a cost seg on, we've got a 6-unit property here in town that's probably worth, $1 million. Like our cost basis in is probably like 500,000.
Yeah.
Like if we were to use do a cost seg, how much of that would go to accelerated depreciation on average? Is it all of it?
Yeah, no. So it depends on the properties, to drill down specifically, but usually somewhere between 20 to 30% of that building is going to be eligible for depreciation. So to give you a quick example of what that might look like, say you had a $500,000 property. All right, land is never depreciated, and you usually calculate the land either by appraisal or using the property tax card. But we'll assume it's 80% is the building, so the building is depreciated. Somewhere between 20 to 30% of that $400,000 will be eligible for bonus. So if we just split it the difference right down the middle, we do 25%. We're looking at $100,000 of that property will be eligible for bonus depreciation, right?
Gotcha.
And at this point, 2024, under the current law that's currently in place, it's 60%. So that would be meaning you're getting a $60,000 deduction from accelerated depreciation, or bonus depreciation is a form of accelerated depreciation.
Interesting. Okay.
So it's almost like if you're planning to like make more money in the future, you almost shouldn't do it. Like if you're going to have like a large exit.
Yeah, it's hard to say that like it's hard to say that like as a definitive thing. It depends because if you're already at the 37% tax bracket and you'll be there when you sell, it usually makes sense to take it now. You have this tax savings, you can go reinvest. But if in the situation when you are in a lower tax bracket today, you're probably going to sell in a higher tax bracket, and I'll throw an and in there, and you're not planning to exit using a 1031 exchange or some other tax advantage strategy, then it would typically not make sense to do the cost seg at that point.
That's interesting. Cause like, this is something that always kind of, I don't want to say grinds my gears, at least. I don't know about you, Dan, but I know we've talked about this before. We know a lot of people that are in like this real estate sort of sphere where they are constantly just told you have to do this accelerated depreciation all the time. And like, I know these guys that are like honestly making like no money. Like they make like 80 to 100 grand a year. They get into a deal as a GP, and now they are like pushing this accelerated depreciation because they've been told they need to do that. But realistically, if they're going to be trying to grow their business, be making $500,000 a year, five years from now, they're probably shooting themselves in the foot a little bit by doing that, because they're going to be now paying more taxes on that accelerated depreciated amount in the future. Like, am I off base thinking that? But like, I guess like I've always sort of viewed it as something that, like you said, if you're already in the highest tax bracket, you should totally be doing it. But it seems to be this reoccurring theme where you have people that are new to the space that are bought into the accelerated depreciation doctrine, and they're like not understanding the true implications that it has over a long-term basis.
Yeah. In certain situations, like I get it. A lot of people like beat that drum because in a lot of situations it does make sense. So it's a good like general rule to say yes. But if you don't have much use, if you can't use those losses today and you don't have a strategic, future use for these losses, then it may not make sense to go ahead and move forward with that cost segregation study and spend the $2,000 on the study of how much it's going to cost you, just to have the accelerated depreciation be suspended and carried forward on your tax return with no use. Now, having said that, though, to give an example of strategic use of this, right? Another way you can use these losses from depreciation if you are on that passive side. So in other words, if you're not on that real estate professional side, is if you are selling a property, right? If you sell a property, you're going to have a big capital gain. You can use losses from cost segregation, from the bonus depreciation to offset the gain on sale of that new property. So that can actually reduce taxes there. So that would be a reason why someone may choose that. But like if you're in that passive bucket, and you don't have passive income or passive gains, if you will, from the sale of real estate to offset the losses, then you're accumulating losses with no purpose, and you're just accumulating admin costs for the cost seg and to get your tax returns filed for no reason. So there needs to be there needs to be a reason for you to do it.
Yeah, that's what it seems like too. With like, I'll like what grinds my gears, kind of following Mike, is I think that there's a lot of newbie investors who have one or two single family homes, and they're listening to cost seg podcasts and like, I got to do this. And two opinions that come from me, and these aren't I'm not saying these are right. I'm just saying these are my opinions, is spend your time. Like if you're going to do it, don't be trying to do it yourself, right? Because there are people that do like their own cost segregation, because you're going to spend so much time trying to figure this thing out. The juice might not be worth the squeeze if you have a house that's worth $100,000 and you're trying to pay $2,000, 2% of the purchase price for a cost seg study, when you don't really benefit it. And the other thing that grinds my gears is there's a lot of people in the real estate space that they don't even make that much money anyways. So it's like, why are you so worried about saving on taxes? Go make more money.
Yeah.
You don't need, your tax bracket's so low now, pay taxes on everything and keep that money as already post-tax.
Right, exactly. You know what it is? I think there's a few things. I think people feel sophisticated when they start doing tax strategy, and like that it's kind of like people starting an LLC. Right? You start an LLC, you're not really in business. Congratulations, you got the LLC. It's one part of it, but it's sexy. People love to talk about it. And when they make moves, they like I said, they feel sophisticated is the bottom line. So it's kind of like an emotional thing for them. But to your point, I would agree. Like when you're just starting out, like, yes, it's important to kind of be mindful and educate yourself on this and see what doesn't make sense for you to use. But your time would be better spent sometimes, and your resources, your cash, your capital, better spent going on finding that next deal than worrying about the nitty gritty tax implications, especially if you're not making that much money. Now, if you're making $500K a year and you're like, okay, great, I could qualify for real estate professional status or something like that, then by all means, this stuff can be really powerful for you.
Totally.
Yeah. And I think another thing with that too, people need to realize is there is an industry around cost segregation studies. There are entire companies that are just, that's all that they do. And they go and they have professional content teams, and they're on podcasts and everything else saying, you need to do these cost segregation studies to reduce your taxes. And all the newbies go, I do. What's this guy's company? Cool. I'm going to reach out to them. And now you're just paying them, right? Which is totally fine, right? Like, I mean, that's why we do this. That's why you have your tax podcast, right? Is to generate customers, it's lead generation. But understand that is why people say things that like sound enticing to you. It is to get your business, to get you to engage with them.
Right.
And you need to understand the fundamentals of this business enough to know if something is actually right for you or not.
Right. And I think the industry around that you're speaking to, Mike, is like there's websites where you go to, they're like, just put in your information. We'll send you a cost study once you get us our credit card information.
Yeah.
Instead of talking to a strategist that like knows like, hey, let me talk about your situation before we actually do a strategy. Cause you may have these other 3 things that are going to be just as beneficial as in addition to a cost seg or something like that. So yeah, don't just put your credit card information in there and get a cost seg study.
Yeah.
Yeah. So cool. Let's swing off the cost segs a little bit. I would like to go just into general tax strategy for investors.
Yeah.
So when you're talking to, I would say people that have professional real estate status are doing regular transactional real estate, wholesales, flips, they own some rentals. What are some of the really common mistakes that you see people making on a tax standpoint?
Common mistakes. Okay. There's a lot of, so mistakes is not having a bookkeeping system. I know it's going to sound boring, but a lot of people don't have bookkeeping systems. And what ends up happening is you lose out on deductions because you have all your expenses in this spreadsheet, this shoebox, this credit card, that debit card, so on and so forth. You paid this cash. You never took a picture of the receipt. And because of that, you end up missing out on a deduction. So that's kind of the first mistake. You got to either put it in place yourself, your bookkeeping system, or you got to hire somebody to do it and make sure you have it there, because that's going to be the bones of not only how you maximize your tax benefits, but also how you evaluate whether or not you're actually performing well, on your business, making money, losing money, so on and so forth. So that's the first mistake. The second mistake I would say is not realizing that when you go from, say, a job to the real estate game, your situation is becoming significantly more complex. So what ends up happening is you have the people who will listen to that 60-second TikTok clip. They'll go and TurboTax, go grab a cost segregation study, realize, okay, they hear about the real estate professional status. They'll go click that on their, they'll go put it into TurboTax, click the button, which is really easy to click, say they qualify as a real estate professional status, and get themselves in the hot water by erroneously using some of the strategies that are out there. So the point I'm trying to make with the mistake here is not seeking the proper guidance. And realizing this isn't just TurboTax anymore. You can go and throw your W-2 into the system, upload your brokerage statements from whatever brokerage, and call it a day. This stuff is more complex to navigate, so you want to make sure you get the professional guidance that is going to be appropriate for your business. Right. Sure. Other things is just so those are the 2 biggest mistakes. Second thing is not engaging a CPA early enough, and I know these are kind of like. People they'll wait till the last minute. They'll be like looking for CPA now. Well, guess what? Tomorrow, 2 days from now, Friday the 15th is the March 15th deadline, which is for partnerships. So all the CPAs are either booked up by now or they're heads down and cranking out work. So you need to start looking for that relationship proactively earlier than this time of the year. And the same goes, that's just kind of another mistake. So I think it's any other like really blatant mistakes other than people just erroneously using strategies. Like just like I said, that's the biggest one. Just not really quite comprehending not saying not comprehending, but not quite getting the whole picture of how these things work, and just going out and doing this stuff without doing it properly.
I learned that the hard way. I learned a couple things when I first started buying rental properties. I was doing my taxes myself. And side note, finding an accountant, I found the best time of year is usually like June, because right after April 15th, they're still cleaning up, and they also are about to go sleep for like 3 days straight, anyways, from working 18-hour days for months. So June seems to be a good time. But when I found this out the hard way. So I got I guess it would be like a fine from the IRS and like interest payments I had to pay. So I found out TurboTax, I was kind of doing what you talked about. Is like you click this button, see what that does to change your tax liability. You're like, ooh, that makes it lower, right? You're like gamifying it. But if you read the little boxes, there's some of that stuff that is like, I didn't do the real estate professional, but it's like, do you qualify? You better meet these because we're going to file it on your behalf. And you said you were. But what I found out is as you click through some of those, they had a glitch, at least this year was like 2016. I did it, where it wouldn't reset certain things. And so what it did was it made me underpay by 50% of my Medicare wages. All right. And so I had to pay like several $1,000s 2 years later. It's always 2 years later. It's never like, hey, we got you. But it was like they had a glitch in there, literally in their software. And then I started Googling this, and it's very common because the software is actually pretty complex for these tax companies, these tax software companies, to actually not have like a perfect system. They can have these glitches where it just doesn't calculate things right. And I was like, good to know. It ended up costing me like $1,000 in like interest payments, and there's nothing you can do about it. And then like the fine was like $250, and then the rest was just interest payments for 2 years. But you don't know that for 2 years. That's why it accumulates. It's not like you can call them and be like, hey, I didn't know until now. They're like, I don't care. First of all, they don't have a phone number, so you can't.
Yeah. And to your point though, that like this, now that you just mentioned that kind of does, kind of double click in my mind. Some of the situations we've seen, like they could get a lot worse than that. Like we've seen people who erroneously took the real estate professional status, save like, $50K in taxes. Now, 2-3 years later, they have to go and they get audited. The IRS finds out that they can't use it. And what ends up happening is they have to pay the $50K back in taxes plus the penalties and interest. And the more you're saving, the more you have to pay back, the higher those interest and penalties are going to be. So it can be quite painful. And one more thing in the mistake that I could throw in there is if you get a notice from the IRS, if you get a notice like saying you're getting audited or they're requesting information, you should go and talk to your CPA, your EA, your tax preparer, whoever's handling your taxes as soon as possible. Right? Like literally as soon as possible. Don't wait 2 days before the notice is due. The IRS usually gives you around 30 days and go to your CPA. Oh my God, I got this 28 days ago. I need to file it tomorrow. Right? That's another mistake. Or worse, you start engaging the IRS yourself, because there's been audit situations where people where they've come to us in the middle of the audit, not the beginning, but the middle. And I said, here's where we are. We gave the IRS all this information. Like, well, you gave them the information already. You're done. You're toast. It's over.
Right.
So the takeaway from there is if you get a notice from the IRS, promptly within a few days, contact your tax preparer and make sure you're getting the proper help to have someone navigate it. Otherwise, you get yourself into hot water.
Yeah. There's some documents we should burn. What should I be burning?
Yeah. I think it's like a general rule. Just don't overshare with anything like that, right?
Totally.
I mean, it's like same with if you're getting like a mortgage, you tell the loan officer what they want to hear. Like if you get pulled over, right, just answer the police officer's questions. You don't need to like tell them everything.
Yeah.
You don't know how they're going to take stuff.
Right. How many beers have you had? 12.
Were you
texting and driving? Yeah.
Right. But same with the IRS, but cool. So I guess as we kind of get into tax time here. We're kind of down to the end of the show as well. What are kind of like the main things that people can be using to look ahead, aside from, finding a CPA, aside from having a bookkeeper, sort of like some general strategies they can be starting like now in like the springtime to the end of the year in like a tax advantage position. So they're not going to be going out to the end of the year and realizing they're going to be owing a bunch more than they would probably need to.
Yeah. So it kind of mentioned some of these things already, so it might sound redundant, but you definitely, if you don't have your bookkeeping system in place, do it now. Get it done. Don't wait till the end of the year and you have to stack everything up and go back through, 8 months or whatever of transactions.
We've done that before.
Yeah,
we have.
It can be painful. It can be painful. So I would say do that. If you're going to qualify for the real estate professional status, start doing that now. To qualify, not only do you have to meet that 750-hour requirement that I mentioned, but you also have to document your time, because if you are ever audited, the IRS is going to come to you and say, hey, prove it.
That is a pain in the ass. Like, how do you recommend documenting that? I've heard horror stories on both sides of that of like, well, I documented it and they didn't like it. Like, is there like a foolproof way? Because we actually just had this question in our coaching group, and I shared with them what I do, but I don't know if it's good.
Yeah, so it depends. It depends. If you're a full-time real estate investor, you're truly in the business full-time, this is what you do, is your bread and butter. You could usually just use your calendar, because your calendar, if you do use the calendar, because your calendar will usually be pretty detailed enough to the point where they'll be able to clearly see, how much time you spent and like, this is legit, like, no issue. But if you're not doing it full-time, or you're just getting started, or you're going to be coming close to the hours and you're not going to, blow it out of the water, I would suggest using some type of either time tracking system like Toggle, or like there's Clockify. There's a bunch of them out there, a bunch of apps that could make it really easy for you, or an Excel spreadsheet.
So would you do like with Clockify or an Excel spreadsheet, you could say like, oh, I'm going to do, say you're a real estate agent and you do that. You push, hey, I'm going to go on a listing appointment. push toggle on, note who you did the listing appointment with, anything like, should you note details on that sort of stuff, or is that required or not? Or is it just, hey, I got proof I did it?
No. So yeah, you would want to put on the more detail, the better within reason, of course. But generally what you'd want to put, say, an Excel spreadsheet is you want to have your date, the amount of hours, the time you spent. You want to have a description of what you did. So for example, fix toilet in unit 43, right? And then what property you spent the time on. And that's usually going to be enough. I think where the issue, though, kind of drill down into kind of what you mentioned, is not all time that you think would spend counts towards the real estate professional stats. And that's where a lot of people get tripped up. So then maybe that is a mistake a lot of people make. But
it seems too like a lot of it that I've read is favored more towards property management than it would be like for Mike and I, some of the stuff we do with our real estate business, because we run multiple real estate type investment businesses. And some of that work is maybe not even on the list of things.
Yeah. So what they want to see is, so there's something called material participation. There's a bunch of tests. We don't have to go through all of them, but basically, long story short, they want to see that you're spending time that's going to impact the day-to-day operations of your property. Right.
So what if you're a real estate agent and that's all you do? Are you a professional?
Yeah. So I could definitely answer that. So there's 7 real property trades or businesses. One of them is brokerage. Another one's rental, property management. There's a bunch. If you're in those real property trades or businesses, you can say this agent, for example, you could spend, say you spent 2,000 hours as an agent, full-time job. You qualify as a real estate professional. You check that box. So you could go ahead and check. But the problem with that is if you do not materially participate in your rental properties, they're still passive. So for example, if I'm an agent, I do that, but I spend no time on my rental properties. I have a property manager. They're handling it full time. They just give me reports. At that point, I would not be able to take the losses from my rentals. So what they're looking for is, are you materially participating in the day-to-day operations of your rental activities? And the way they see that is usually you don't have a property manager. Usually you're the one, either you're running point or you are the property management company, so to speak. That's usually what they're looking for. So what ends up happening is people will be a developer, or they'll be a flipper, or they'll be a agent, and they won't have any time spent on their rentals, and that can trip you up too.
Gotcha. That's super helpful.
That's very, very helpful. That's one of the most confusing things that we get asked all the time. It seems to be such like a gray area. And honestly, it's very almost like subjective, like really like how you can view the different things. And, it leaves it open to like, I don't know, someone could fudge their hours, I guess.
Well, the way I was like thinking about it previously is like I would have so many Home Depot receipts, and I actually started tracking. I use Mile IQ is the app I use, and it tracks automatically your drives, and it says, "Hey, where were you going? Was this for business or personal?" When it just already knows. And then so I was like, well, you combine that with the Home Depot receipt I have, like that's pretty good freaking proof that I went to Home Depot. Now I just need to say what property it was for, because it would be like, hey, I am driving to Home Depot, picking up whatever, 2x4s, taking it to a project. Like that whole process that maybe took 3 hours, that there seems to be a proof without any doubt that that's what I did.
But then where it gets gray, right, is let's say you do that Home Depot trip. On the way home, you go and pick your kid up from school, and then you go to the grocery store. It's like, what point? Like you have to stop it.
That's where because the way my app actually works is like it knows when you stop, but then you would have to you still have to classify all of them, right? So you can spend a ton of time here, and I think the challenge is like you could spend 4 hours a week easily just tracking your time.
Yeah. You have to be careful. There's a balance to it, but if you do it proactively, use like an app, it's not that bad.
Right.
Awesome. Well, we're right up on time here, Thomas. And you want to tell everyone what you do for people in the tax strategy world and about your podcast that you run?
Yeah, absolutely. So we help real estate investors reduce taxes. So it doesn't matter whether you're full-time, you're passive, you're doing it you're commercial, residential. We work with real estate investors across the spectrum. We also do tax preparation, so we can file your taxes, and of course, outsource accounting. And then we have a podcast where we dive deep into all the strategies we discussed here and a lot more. That's Tax Smart REI podcast. It's on Apple, Spotify, wherever else. But that's what we do. We help people reduce taxes, streamline their accounting systems, and then we have the podcast, which helps kind of get that message out there and helps kind of clarify for people what is possible, because we do go in depth. We don't do the 60-second TikTok clips on the podcast, though.
Awesome. And then if people wanted to follow you directly or reach out to you, what's the best way to do that?
Yeah, the best way to do that would be to go to thomascastelli.com/links. There, I just have all my links, my social. I'm going to be really active on Twitter this year. So Twitter would probably be the best place to contact or connect with me.
Perfect. Sweet. Yep. And we have your LinkedIn, your Twitter, your Instagram, your TikTok, your website, and your YouTube all in our notes. So we will put all those in the show notes below the show. So Thomas, man, thanks so much for coming on the show. We really, really appreciate your time. You're obviously a wealth of knowledge, and I'm sure Dan might have some additional questions for you as well. So hope you guys appreciated all of the information that was dropped here. Definitely reach out to Thomas if you're trying to figure out any of these confusing tax strategies or situations that come around owning a real estate investment business. Remember, people come on these shows because they want you to engage with them. So don't be shy. Shoot him a message. Check out his business, and we will all make a mutually beneficial sort of ecosystem here where you are learning, he's getting business, and people will still keep wanting to come on here because it's worth their time. So appreciate you guys. We appreciate you guys all listening, and we'll talk to you next week.
Thanks, Thomas.
Bye. Thanks for having me.